As of the close on Friday, May 10th, we still have a bullish migration taking place toward economically sensitive sectors. This is the title slide from last week. So the divergences that we had been concerned about had been resolved in a bullish manner. The charts did help us. High beta ETF up 3.7% this week. Small caps up 2.2%. The triple Qs or tech up 1.3%. S&P 500 ETF up 1.2% this week. And risk-off related Treasury bonds, TLT, dropped 1.8%. If you follow our work, you know for weeks, if not months, we had numerous bearish divergences relative to the S&P 500 continuing to climb. I thought it was interesting this week, Pension Partners on Twitter, and Pension Partners does their homework, they know their stuff. They noted that the recent gains in the S&P 500 with credit markets and other areas of the markets not confirming that was an outlier period that we've not seen since 1958. So what happened recently in terms of the chart somewhat giving us a head fake is very, very rare, but it does happen from time to time, and as we noted last week, we did make some changes to our weightings and our models to account for that. This is a slide from last week where we noted the weak charts had flipped in the bulls' favor. That's still the case, and in this week's video, we'll quickly scroll through many of those charts showing how they looked as of the close on Friday, May 10th. We've been redeploying cash over the past few weeks. Our models, our risk model on a scale of 1 to 100 moved from a somewhat neutral and tepid and hesitant 56 on April 17th all the way to a bullish, firmly bullish reading of 94 this week. The 94 tells you that the bears have work to do. The charts currently look bullish and something needs to change in terms of the bears having a better outcome. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a weekly chart of the NASDAQ Composite Index, few points. Resistance, resistance, tested resistance twice here and has successfully moved away. That's bullish. 22-week, turning up, all things being equal, bullish. Good things tend to happen when momentum is in an overbought position. We've regained the overbought territory. Concerns would increase if we drop into this area here. This looks good as of Friday's close. We use this chart in the Cyclical Capital Management Bull Market Sustainability Index. One of our models, this is NYSE or the New York Stock Exchange, advancing volume minus declining volume. So it's net volume, advancers minus decliners. You can see resistance, acted as resistance, acted as resistance. This chart seems to be breaking out. All things being equal, that's a good sign. Typically, it's also a good sign when this moving average has a positive slope. Just like the previous chart, this is a monthly chart of the S&P 500, so these are stocks going all the way back. This is late 1998. Resistance, resistance in the general area, resistance, bear market. Here we stalled a little bit, but we appear to be breaking out above this very, very long-term resistance. This is a long base that we have here, and if this breakout holds, it could be very, very bullish for stocks. You can get head fakes on breakouts sometimes, so we'll keep an open mind, but as long as we stay above this blue line, it's good for the stock bulls. Same concept here, just on a weekly basis. You can see acted as resistance. We came back down, and now we're back above. The longer we stay above this blue line on the weekly S&P 500, the better. We reviewed this chart last week and said from a trend following perspective, good things tend to happen when the blue moving average is above the red, price is above, and the slopes are up. You can see here after a few hiccups, this looks bullish from a trend following perspective for the weekly S&P 500. Something has to change and look like this for us to become more concerned. We've tweeted this chart a few times in the past few weeks. You don't need to be on Twitter or know anything about Twitter to visit our Twitter feed and see these charts. Anybody can click on them. This is hedge or a hedging ETF. Think of it as shorts relative to longs. Typically when the market's peaking, it catches a bid. You can see here, there's really no bid here, no yellow flags here yet for the stock bulls. This is a risk-on, risk-off chart that we've looked at for weeks, if not months. Clearly, we got a breakout. Stocks relative to bonds, resistance, resistance, resistance in this area. Now we have 2 weekly closes above. The longer this holds, the more bullish it is for stocks. Last week, we noted what appeared to be a bullish turn in QQQ or tech stocks relative to the S&P 500. Held here, outperformed a little bit this week. Blue is over red. This period here looks similar to this period here, and this period here where gains from a probabilistic perspective tend to follow. Similar to the HDGE divided by S&P 500 chart we just looked at, this is bonds risk off, aggregate bonds divided by stocks. Similar situation here. When the market corrects, this ratio tends to catch a bid. Don't have anything like that. In fact, we have a bearish breakout. This is a bullish look as it stands now for stocks relative to bonds. The S&P 500 also outperformed the VIX this week by over 3%. All things being equal, this is a bullish look. We've got blue back above red. That's a bullish moving average crossover with price on the ratio of the S&P 500 relative to the VIX above both moving averages. It appears as if a market leader, home builders, you can see been leading for a long time here relative to the S&P 500 weekly. Somewhat of a consolidation period here. Looks a little shaky here with a bearish crossover with the moving averages. It seems to have righted itself and retested this breakout and appears to be moving higher again with blue over red and price above the moving averages. So weekly chart of small caps in isolation has a bullish look. Blue, MA above red, MA slopes up. Consolidation. Here's a breakout and a higher high. Williams percent R back in overbought territory. In terms of the bullish script, is everything being followed to a T? No, it's not. We still have some relative weakness in basic materials and emerging markets. When I say relative weakness, they haven't turned the corner fully yet. They look like they're trying to turn, but we'd like to see basic materials and economically sensitive emerging markets turn as well. Hopefully that'll happen in the next 2 weeks or so. Materials here bounced. S&P 500 did well. Materials, IYM, weekly bounced. S&P 500 did well. It appears as if we've bounced in a similar location, which leans bullish for the stock market. We covered this chart in detail last week. If you want more information, go to the Shavaco Capital channel and watch that video. Last week, we said this looked bullish. It still looks bullish. This is the credit markets. Junk or riskier bonds are turning relative to conservative bonds. This tells us the credit markets are becoming more open to accepting risk. This is a chart we monitor. This is a high beta stock, Monster Worldwide, relative to shorting the S&P 500. You can see this resistance here goes back to 2011, rejected, 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 rejected. It appears on a monthly basis, and we've got a long way to go before the end of the month, that this is trying to break out in a bullish manner. You could also make an argument that it has economic consequences, since Monster has to do with unemployment rates and resumes. Another update to a chart we discussed last week. This is small caps risk on relative to treasuries TLT risk off on a weekly basis. You can see last week it started to turn, and the turn still looks good with blue over red and price above moving averages that are sloping in a bullish manner. Same concepts here, stocks relative to bonds weekly. The S&P 500 outperformed TLT by 3% this week. As long as this chart looks like this, the odds favor stocks outperforming bonds. Is it possible that the stock market experiences a correction? Sure, it's possible. It's always possible. This is SPY divided by the aggregate bond fund risk on relative to risk off. Point of showing it, we had this long-term, almost 2-month consolidation here and a bullish breakout for stocks. It's not unusual to come back and retest a breakout. So if the stock market weakened relative to bonds, when this ratio gets down to this area, that might be a good entry point. Nothing says we have to retest it, but it could happen and we have to keep an open mind. If you watch our videos each week, you've seen this chart before, SPY relative to IEF, intermediate term treasuries. Point of showing it, it appears here as well that your resolution of risk on versus risk off favors the bullish camp and stocks relative to bonds. XLP relative to the S&P 500 this week fell 1.35%, so defensive consumer staples, their leadership seems to be waning. These moving averages are trying to roll over. It looks a little bit like this period right here where the stock market went up and then eventually peaked. All the comments from the last chart apply to utilities XLU relative to the S&P 500. This is a defensive play, lost a lot of ground, 3.74% relative to the S&P 500. The fact that utilities are underperforming now tends to be bullish for the general stock market. Similar concepts here. We have somewhat of a risk on versus risk off, consumer discretionary relative to consumer staples on a weekly basis. You can see during 2013 we had the outlier scenario where this ratio was weak. This ratio gained quite a bit of ground, 2.39% this week, back above the moving averages. Blue remained above red, and the moving averages are trying to turn back up. You can make an argument that it's similar to this period here or here. You can also make an argument that it's similar to this head fake period here, so we have to keep an open mind. The charts are bullish as of the close on May 10th. We'll maintain maximum flexibility. As long as they're bullish, we'll remain bullish. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Cyclical Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.